You can experiment with your investments. Choose the stocks you like one by one, or select Sector Spider ETFs and add the diversification of an entire sector of the S&P 500, like healthcare. With liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
Well, how much money do you need for a comfortable retirement? Well, thanks to viewers like you, that was ETFguide's #1 watched video episode over the past year. And on that episode, we had Ron Surz, president of PPCA. He was our program guest. This time, he joins us again. His firm focuses on investment portfolio construction for retirement plans. And this time, we're going to tackle a related subject. How much money can people withdraw from their investments without depleting the principal? Now, this is something that I know a lot of our viewers are in this situation and they're wondering about this. So as more people move away from the retirement income accumulation phase of their investment plan and into the retirement deaccumulation phase of their plan, what are some things that people need to be focused on?
Now, the key thing they should focus on is saving enough. And you can maybe try to make up lack of savings with risky investments, but that's not a good bet. And the second thing, so save enough is the first key, and the second one is don't lose it. And especially as you're getting close to retirement. So in our previous interview, we talked about how much people need to save. And currently, with this lousy economic environment, at least low interest rate environment, it's about 15% of pay.
That people should be saving.
Yes, and that you know, hopefully the employer will match something, so 7.5 for you, 7.5 for them. But that's a big number. And the other important thing I think for investors to keep in mind is that there's a risk zone. And the 5 years before and after retirement are extremely critical to your lifestyle, the way you're going to live. So I think as retirement gets close, people start to adjust to a certain lifestyle, and it may not be the one they're used to, but you start to get mentally prepared for whatever you can afford in retirement. The other thing that we didn't mention in the previous interview, that there are other things you should be thinking about as you get close, like when do you take Social Security? And Social Security is really complicated, and I've been reading stuff where advisors will help you sort of agree to take Social Security at the right age, 66 or 67, and then you defer it. And that for some reason, agreeing to take it at one point and then deferring it leads to higher benefits later on. And I have no idea. Like just waiting to 70, it wouldn't work. But issues like that and healthcare is a serious concern in retirement. Should you do long-term care insurance, stuff like that. So those are the issues, I think, for people
now
in retirement.
Let's talk about this 4% withdrawal rate, which for a long time in the financial services industry has been kind of the default standard of what a person can withdraw from their retirement plan without depleting the principal.
Right. So that number, the 4% is a number that has been around for a long time. People are thinking now, with low interest rates, maybe more like 3%. But there's an article that just came out that I want to recommend to your viewers here. It's called The Only Spending Rule You'll Ever Need. It's by Larry Siegel and Barton Waring. And in there, they go through the various formulas and who wrote them and the logic behind them. But they recommend what they call an annually recalculated virtual annuity, ARVA. And the idea there is to say, take your current money, and if you go out and buy a variable annuity, which would adjust and increase by the rate of inflation, and you can use Excel to calculate this, by the way. So they give you the formula. It's a very simple formula. Whatever that number is in the first year, that's what you spend. And then whatever happens during that year, investment-wise, is going to affect the calculation at the beginning of the second year. You recalculate it again, and you spend whatever that formula tells you can spend. And the idea there is they talk about those investments that are going to impact the volatility in your spending, and they define what they call spending volatility as being the risk. So if you want to take a lot of risk with your assets, you're going to take a lot of risk with your spending. Yeah. And that's the trade-off. The interesting thing that they show in that article, though, is for that sort of typical investor, that spending would start out at around 4%. And by the end of 30 years, is the horizon they sort of use, you'll be spending about 35%. Now, what's going on there, of course, is you're spending down principal. You're not trying to keep the principal. If you had a bequest motive where you want to leave all the principal to your kids, that's a different story. I don't know how many of your viewers really want to do that.
Yes.
We want to spend our kids' inheritance.
Okay.
the kids are fine.
Yeah.
But for those who are concerned about outliving their money,
Yes.
a lot of people have put out things that claim that they can manage longevity risk.
Yes.
But I have a fund that is guaranteed where you won't outlive your money.
Tell us more.
It's called the Hemlock Fund. And the ticker symbol is FINI, Finny.
Finny, not funny.
Finny. And what you do is you give us all your money, and you tell us however you want to invest it, we don't care, in a self-addressed envelope. And when we get
I
down,
don't like the sound of this.
well, when we get down to your last $20, we send you a cup of hemlock in that envelope. Now, hemlock is poison, in case you don't know. So, and that's our solution.
Well, thanks for those ideas. You just heard from Ron Surz at PPCA. I'm Ron DeLegge with ETF Guide.